Many of us are familiar with mutual funds. They're likely in your 401k or IRA. But more and more, investors are seeing funds with the letters ETF, or Exchange Traded Fund, following their name. If the meaning of that is not immediately clear, stay tuned. Exchange Traded Funds and mutual funds, what's the difference? Coming up. Jeff Drayton, Certified Financial Planner Professional and founder of Jeffrey A. Drayton Financial Planning and Wealth Management, LLC. If you're watching this on YouTube, go ahead and subscribe. And if you are viewing this from my website, fill out the sign-up form at the top of the blog page so that we can contact you when new content becomes available. Most of us are familiar with mutual funds, and for good reason. They've been around for a long time. Mutual funds have been popular with individual investors because they offer a number of advantages. They make it possible to achieve a high level of diversity in one's portfolio. They offer professional management, and in some cases, they give individual investors access to certain asset classes that might be less accessible otherwise. However, lately, a cousin to the mutual fund has been gaining in popularity. This is a type of fund that trades on an exchange, like a stock, and is therefore, not surprisingly, called an exchange-traded fund, commonly referred to as an ETF. In many portfolios, you will likely see a combination of both, mutual funds and ETFs. However, in conversations I have with my own clients, I know that there's a fair amount of confusion as to what the difference is. Recently, a client told me, yes, I know the difference. ETFs are index funds. Well, unfortunately, no, that's not it. Many ETFs are set up as index funds, but there is certainly no rule that says that they have to be, and some are actively managed. Furthermore, it certainly would not be true to say that mutual funds cannot be index funds. Many are. The difference is exchange-traded funds are traded on an exchange, and mutual funds are not. So in this video, I'm going to explain some of what that means and how it might be relevant to you. Here goes. Imagine you were considering investing in a fund and you were trying to decide between, say, ABC Company's Large Cap Growth Mutual Fund and ABC Company's Large Cap Growth ETF. This is a very plausible scenario. Many investment companies, the companies that create and manage both mutual funds and ETFs, might offer two nearly identical funds of both types, one a mutual fund, the other an ETF. Now imagine you decide to purchase shares in the mutual fund. Who are you purchasing those mutual fund shares from? Of course, likely you are placing your order through your brokerage firm, but mutual fund shares themselves are coming directly from ABC Company. You see, mutual fund shares are purchased on the primary market. They come directly from the issuer of that fund. It's possible the shares that you purchased didn't even exist until you bought them. The investment company is free to issue or redeem shares as needed. And when they collect your dollars, they will simply add those to the pool of assets from their other investors and then invest those assets according to the mutual fund's prospectus. Furthermore, when it is time to redeem those shares, meaning now you want to cash out, again, it is the investment company that will purchase those shares back, and if necessary, liquidate whatever portfolio assets are required to do so. Because investment companies are free to issue and redeem mutual fund shares as necessary, this system allows mutual fund shares to sell for something called NAV, which stands for Net Asset Value. This means that the value of each share in a mutual fund is simply the combined value of all the assets in the mutual fund minus the fund's expenses divided by the number of shares outstanding. Each share is worth exactly its proportional value of the fund's net worth. No more, no less. Now let's contrast that with the way an exchange-traded fund works. ETFs trade on exchanges, just like stocks. So, for this example, I'm going to leave the world of mutual funds and ETFs behind for a minute and talk about how stocks trade. For this example, I'm actually going to use a real company. Let's say Coca-Cola, ticker symbol KO. If I want to purchase shares of Coca-Cola, I place my order with my broker, and that order will then go to an exchange, say the New York Stock Exchange. And that is where my order will be filled. That's where my stock will be purchased. So who did I buy it from? Well, I'm purchasing shares in Coca-Cola. I'm becoming a part owner in the Coca-Cola company. So one might assume I purchased my shares from Coke. No, Purchasing shares in a large, widely traded company such as Coca-Cola as an individual investor, it is a virtual certainty that the company will have nothing to do with your stock purchase. Instead, I will have bought my shares from someone who owned Coca-Cola stock and who now wants to sell their shares. They had an order in to sell, I had an order in to buy, and therefore their shares were purchased by me. Hence the term stock exchange. You might ask, does this mean that if no one who owns Coca-Cola stock wants to sell their shares, I won't be able to buy any? The answer is yes, that's exactly what it means. There are a set number of Coca-Cola shares. For a company like Coke, it's a big number. But at any given time, whatever that number is, there are only that number of shares available. However, in a large, widely traded company like Coke, this has virtually no possibility of happening. Why? Because it is the stock exchange's job to ensure an equal number of buyers to sellers, and vice versa. So how do they do this? It's simple. If there are more buyers than sellers, they simply raise the price of the stock. This will discourage buyers and encourage sellers. Raise the price far enough, and eventually a point of equilibrium is reached. If the opposite happens, too many sellers, not enough buyers, now the price goes down, again until they reach a point of equilibrium. This is what determines the price of a stock. Analysts speculate on a wide number of things that they feel will affect the value of each equity, but these are simply the determining factors as to how many buyers and sellers they anticipate will show up each day. The tip of the spear of what determines a stock's price simply boils down to supply and demand. The price is market driven. If there are more buyers than sellers, the price goes up, vice versa, the price goes down. ETFs trade like that. In any ETF, there are a set number of shares, and to purchase shares in an ETF, you will place your order with your brokerage firm, and that order will go to an exchange to be matched with a seller, someone who owns that ETF and is now looking to sell. For this reason, do ETFs sell for NAV, their net asset value? No, they don't. Their price is market driven. Therefore, it would only be an unlikely coincidence were an ETF to be trading for exactly the value of all of its assets minus expenses divided by the number of shares. Sometimes ETFs sell for a premium, meaning the cost of the individual shares is greater than the value of the underlying assets that those shares represent. They can also sell for a discount, which would be the opposite scenario. Typically, the market value and the net asset value of an ETF's shares stay pretty close. The market likely wouldn't let those two values stray too far apart. But the fact that the two values will be different is something to be aware of. So, which is better? Is it better to purchase shares in a mutual fund whose share value is always net asset value, or is it preferable to buy ETF shares whose value is dictated by the market demand for that ETF? Well, like many things financial planning, the answer is it depends. Certainly, if a primary concern for the dollars that you are placing in a fund is principal protection, the fact that ETF shares do not trade for NAV might be a concern. Imagine if you have bought a short-term bond fund primarily hoping to maintain the value of your assets. If market conditions change such that bonds fall out of favor and their values decline, an ETF might be doubly hit by the fact that not only are the underlying assets, the bonds, losing value, but the ETF itself might take a hit to its share price, possibly selling at a discount to NAV. This won't happen in a mutual fund. However, that would be a very specific concern. Something that has made ETFs popular is their efficiency. ETFs commonly have more attractive expense ratios than their mutual fund counterparts, and this is for a variety of reasons. One in particular is that many mutual funds have included in their expense ratios fees to cover marketing and distribution costs, expenses that are not found in ETFs. Also, ETFs are frequently more tax efficient than mutual funds. When mutual funds sell assets to redeem shares, this triggers a taxable event. However, since ETF shares are not redeemed, they are simply traded between investors, no underlying assets need to be sold simply because shares of an ETF traded hands. Lastly, mutual funds commonly have minimum investment requirements, frequently in the thousands of dollars, and for smaller investors, this can be prohibitive. The minimum investment amount for an ETF is the cost of one share. With ETFs, it's possible to participate in the market with even a very modest initial investment. As you can see, when it comes to choosing between mutual funds and ETFs, there is a lot to consider. For thoughts that are specific to your situation, I suggest that you speak to your, hopefully, certified financial planner professional. I'm Jeff Drayton. Thanks for watching. Nothing in this video is meant to be specific advice for you. Advice like that can only be had by working with a financial planner, someone who knows you and your situation. I would encourage you to seek out someone who is a certified financial planner. This is signified by the letters CFP with the registered trademark sign following his or her name. I would also encourage you to work with a fee-only financial planner. Now that's two words, fee-only, not fee-based, not fee plus commission. Both of those terms mean that the planner or advisor can receive commissions and is therefore not free of the conflict of interest inherent to commission sales. Again, I'm Jeff Drayton. Thanks for watching.